Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here today with our host, Robb Fahrion, the CEO and founder of Flying V Group. Flying V Group is Deep Knowledge Investing's marketing partner. Robb, good morning. Glad you could make it early on a Sunday. We're filming early today.
Yeah, we're getting ahead of the ball. Got a big week upcoming. Last week was a big week. Lots to catch up on this week. So we're getting ahead of the game. So that's exciting.
Yeah, there we go. And the good news is we have a double bonus issue. So we instead of 5 things, we have 7 things this week. It was a news heavy week. So either we're giving you guys extra value or we can't count. I'm apparently the only one who likes that joke, but here we are.
The issue this week we're calling the opposite day issue. And Gary, yeah, you're exactly right. Jam-packed issue. We're gonna have 7 things. So I know we're going a little bit off brand this week, but 7 things we'll talk about. Various topics. CPI comes out. We're going back to DKI stock pick, Shockwave, as well as we'll talk a little bit about Macau and what that means for LVS, Japanese recession. So we've got a long list here lined up for everybody. And as you've been seeing as well, content distribution, we've been cutting things up, different topics and distributing as well. YouTube, Instagram, Twitter, X, trying to get you all the information on all the platforms and channels. So yeah, Gary, your face is going to be plastered everywhere at some point, or at least that's the goal.
Yeah, and look, everyone. So 2 things. One, we want to give credit to Deep Knowledge Investing intern Andrew Brown, who's been putting together the short videos. Andrew, great job on this. If you send me an email, I'll know you were watching the video. If you don't, then you got praised quietly. Yeah, and then that's pretty much the story on that. So, Robb,
Great.
whenever you're ready to get going.
Perfect. We'll jump in. 5 things. This week's going to be 7 things. Thing number 1 is the January CPI is above and comes in above expectations.
All right. So CPI stands for the Consumer Price Index. It is generally regarded as the index for inflation. Now, between all of us, these numbers are so adjusted and so screwed up by the government that it doesn't actually measure inflation. On top of that, everybody's inflation rate is different, right? So if in the last few years you had to buy a new house or rent a new place or sign a new lease on somewhere where you're living or buy a new car, your personal inflation rate is going to be very, very high. For other people, it'll be lower. And so everyone's going to have their own inflation rate. But the CPI, the Consumer Price Index, is the index that most people look at when they're trying to think about inflation or the cost of inflation. And the way I really want to rephrase that is inflation is the loss of purchasing power of your dollars. And so, imagine last year you worked really hard. You didn't necessarily spend as much. You held off on maybe some big purchases or an expensive vacation, and you saved a bit, and you have 1,000 or 5,000 or $10,000 in your savings account, in your checking account, whatever fits your personal circumstances. Maybe it's $100, but the point is, with inflation, the value of that, the purchasing power of that money, will be decreased a year from now, and that's why inflation is so insidious. Now, the Federal Reserve has been trying to get inflation, which has been running very high the last few years, down to its 2% target. And 2% is still theft. It's still wrong. It's the way they do it. And if you take a look, the Fed's mandate is actually stable prices. That's a 0% inflation rate. Them saying, oh, we've got a 2% target, that's sleight of hand for stealing from you. But like all of these government statistics, there are certain psychological numbers that matter, right? So as you get close to 2%, people will say, okay, great, the Federal Reserve has done its job. They're going to ease up a bit. The CPI last month was 3.1%. People were expecting 2.9%. And so you think, okay, well, is 0.2% really that big a deal? And it is. It is for 2 reasons. One, the less important reason is psychologically, people were hoping to see a number below 3%. You didn't get that. The other thing that's happening is when you look at sequential inflation, which sounds like, something complicated, it's really not. It's just saying, what's the change in prices from last month, right? This is sequential number. That was up 0.4%. You think, okay, wait, why is 4% a big deal? And it is because that's from a month ago. Right.
Right.
And so what we're really looking at is that monthly inflation number annualizing at 5-6%. On top of that, services prices were up another 5.4%. That's been a problem for the Fed. Those numbers have been incredibly sticky. And then the other thing that we saw is the core CPI, which is the consumer price index excluding food and energy, was up 3.9% year over year. That's about double the target. And that also was above the 3.7% that people were expecting. The conclusion here, higher for longer. You know, the Fed's
Right.
looking at these numbers, and instantly what happened was so remember, a few months ago, a lot of Wall Street was expecting rate decreases by the Fed in January, and deep knowledge investing in these videos, we told you, not going to happen. And then we got some data and everybody started thinking, okay, it's going to be March. And we said, no, it's not going to happen in March. And then, you know, everybody's expectations got pushed out to May. And now the minute the market saw these results within one day, expectations for the first rate decrease got pushed out from May to June. And so in the last month or two, the bond market has gone from expecting the first rate cut to take place in January all the way back to the middle of the year. When Powell says higher for longer, you got it. This is what's happening.
Higher for longer as the Fed continues to tackle inflation, or at least try to. Point number two kind of aligns. Our PPI, producer price index number, agrees with that CPI and is in alignment.
Yeah. So let's think about the PPI, the producer price index, as the wholesale version of the CPI, right? So as consumers, as individuals, when we go buy something, we really think about the consumer price index. How much more are we paying for something? The producer price index, remember, the companies that provide the products that we consume, they have their own expenses, right? And so they track their own inflation rate. And so the PPI is really like the wholesale version of the CPI. And in general, what that means is that a higher PPI means a higher CPI is on the way. And that might sound complicated, but it's really easy to explain. When the costs for manufacturing an item rise, you can expect that if a company is spending more to manufacture that item, that a month or 2 months or 6 months down the road, as consumers, we're going to see those higher expenses in the prices that we pay. Now, this week we got last month's PPI as well as the CPI, and that was up 0.3% from last month versus expectations of 0.1%. This matters for two reasons. One is this is a big increase. 0.3% in a month is a big one, and the core PPI, again, excluding food and energy, was an even bigger surprise. That was up by 0.5% versus last month, which was way above expectations for 0.1%. If you want to know why that matters, it's because a 0.1% gain annualizes to 1.2%, well below the 2% target. That 0.5% monthly gain annualizes to 6.2% because there's compounding. That's why it's not 0.5 times 12. It'll be a little bit higher, so 6.2%. So one of those, what was expected, is something that was well below the target. What we got is a disaster. Inflation above 6% is a huge problem for the Federal Reserve. It's a huge problem for consumers. It's enough that, you know, governments will change hands over that. The other reason this matters is because the prior month, the PPI was actually down. We actually had deflation. And so there was hope that with manufacturers' prices down versus the prior month, that we would start to look at decreases in the CPI coming down the road and that everything was really under control. So a month ago, that was something that led people to think, hey, maybe the Fed can reduce rates. In a situation where the PPI, instead of 0.1%, you get 0.5%, or instead of 0.1%, you get 0.3%, whether you're looking at the core or the regular, these are big differences. And so the conclusion here is, everybody say it with me, higher for longer, right? The Federal Reserve, looking at these numbers, is not about to reduce rates.
Higher for longer, higher for longer. We've been hearing that, saying that, and that is going to continue as a constant theme on this DKI 5 things.
Yeah, and the thing I would add to that, all year, the market has been expecting 6 Federal Reserve rate reductions. Each reduction is 25 basis points, which is 0.25%. So what people were expecting throughout this year was a decrease of 1.5%, 6 times 25 basis points. And Rob, how many times have we been on this particular show, this particular the 5 things video version, and we've simply said take the under. There is
Yep.
no way in the world the Federal Reserve reduces rates 6 times in 2024. It's looking like we're going to be right on that. At least it does now. You know, we can change our opinion later.
Get those bets locked in. Call the bookies immediately.
Yeah, exactly.
Point
Your Federal Reserve bookie.
point number 3. A little bit of the opposite trend we're talking about. Retail sales and manufacturing data are reversed.
Yeah, this is why we call this the opposite day version. One of the things we've been talking about here on this show is the inconsistent data. We've talked about upstream versus downstream. And again, just a fancy way of saying we've been seeing the consumer spending a lot, right? So great consumer sales numbers combined with miserable manufacturing numbers.
Right.
And so what's happening is the consumer spending like they'll never have to pay their bills back, or like the value of the money that they have is going to decrease, right? Inflation encourages people to spend now rather than later, versus manufacturers who looked like they were getting ready for a recession and reducing their output. And so this week we got a complete reversal of that. Advanced retail sales for the month were down 0.8%, which was much worse than the negative 0.3% expected, making things even worse. Last month, strong retail sales of up 0.6% were revised down to 0.4%. So basically, 1/3 of last month's increase got wiped away with just a revision. And then this month, retail sales were down more than double what was expected. And that's, that's not a great trend. Now, on the other side of it, we saw a huge reversal on some of the manufacturing indexes. The Philadelphia manufacturing index was at 5. Okay, is that good? Is that bad? It's a marginally positive number, but here's the key thing. It was 16 points above last month and a huge beat against expectations for -8. So people were expecting -8, you got +5. We saw the same thing in New York. The New York survey was -2. So a slight negative there. All right, that doesn't sound great, but last month was -44.
Right.
That index went from -44 to -2. It's a huge, huge change. So we're actually looking now at the same time as manufacturers seem to be saying, you know what, we see the consumer spending, we better start producing for them. So that perfectly matches the same point that the consumers say, yeah, we're running out of money.
Cat and mouse game for everybody.
It really is. And like it's kind of funny until you're looking for an item and can't find it, or you have manufacturers going out of business because they produce too much. I mean,
Right.
the last thing you want, everybody loves to say we want lower prices, and you do until the companies that make the things that you like go out of business, and then you're left with something else.
Great point. Moving forward, point number 4 of this week's 5 things from Deep Knowledge Investing. Moving to a portfolio company, Shockwave Medical, trades as SWAV. They announced beat earnings expectations and grows the market.
Yeah, so Deep Knowledge Investing subscribers got into Shockwave in December at just over $190. I was buying at 191. I got a nice note from one of my subscribers yesterday who told me he was buying at 189, 190. Going into last week's earnings, what we had was the stock had run up from 190 to the mid 230s. And then after a fantastic quarter, stock actually ran up to 270 and closed in the mid 260s. That is a really nice gain for our subscribers in 2 months. But, even then, Rob, we came out publicly on this and we told people that we were investing in this. And I think the stock was around 230, 235 at the time. So, even had you not been a subscriber, you could have come in later and made great profits on this. The earnings report was very strong. Shockwave announced fourth quarter revenue growth of 41%, which is fantastic. Earnings per share of $1.16 were far above analyst expectations of 89 cents. The company's talking about getting about 100 basis points or 1% of operating margin lift in 2024. That will be improved in 2025 from efficiencies that come from the new Costa Rican manufacturing facility coming online this year. And then the other thing is, I've been talking with interventional cardiologists, and somebody who is part of the deep knowledge investing community and a cardiologist sent me this fantastic chart this week. And the thing that's amazing about this is Shockwave's IVL product. That's their product that they use electrical pulses to break up calcification in arteries. That was first commercially approved in the first quarter of 2021.
Correct.
Since then, look, it's impressive enough that Shockwave's market share right now is about 50% of these advanced difficult procedures. But the more important thing is, in that time, the market has grown from 11% of these procedures getting some sort of advanced product used on them to 16%.
Right.
Right. And that is a huge increase. What that means is that people who had previously cases that were previously difficult or impossible, or where they could get the stent in, but the long-term medical prognosis of that stent wasn't going to be positive, all of a sudden what Shockwave has done is not just taken share from weaker companies that just have product that isn't as good. More importantly, they've been able to grow the market. The market itself is almost 50% larger, and that's a huge difference maker.
Yeah, definitely big just in terms of that technology being able to be used. And Gary, you guys have done a great job kind of breaking down what it is, how it works, and then bringing in the investment angle as well. So exciting things for Shockwave, and we'll obviously keep everybody in tune with that as things progress over the course of this year. Point number 5 ties to LVS, Las Vegas Sands, but it's Chinese New Year and Macau visitation is above expectations. We all like that.
Yeah, fantastic. So happy Year of the Dragon to everyone. That's
Happy
what
Year of
we're
the
in
Dragon.
now. And in China, one of the ways that people like to celebrate Chinese New Year is by going gambling. It's just part of the culture there, and the reason that Macau has been the gambling capital of the world for more than a decade. So, Rob, what people were expecting through the 8-day, or for the 8-day Chinese New Year holiday is visitation at Macau of about 960,000 people. That's what they were looking for. 4 days into the 8-day holiday, Macau was very close to that levels, around 900,000.
Yeah.
Yeah. And so we've pulled the data on this, and the year you want to compare with is 2019, because that was the most recent pre-COVID year where you didn't have lockdowns in China affecting visitation in Macau. And for the first 3 days of the holiday this year, the visitation numbers were far above where they were in 2019. For days 4 and 5, they were slightly below. So basically, 5 days into the 8-day holiday, not only is Macau going to come in way, way above expectations for visitation, but 5 days in, they're actually running ahead of the rate that they were in 2019. All of this huge positive for Las Vegas Sands. The thing that we keep telling people on this one, and we've been saying this for a long time, is what you get with Las Vegas Sands right now is full recovery, fundamental performance at pandemic level distressed prices.
Right.
That stock's been on a run lately as well. Last couple of months, it's up more than 20%, which we're thrilled about.
Great. Point number 6, Japan enters recession. The yen falls again. Gary, give us the breakdown on what's happening there.
Yeah, so we've been talking about issues in Japan for about a year and a half now. I first started talking about Japan potentially facing a sovereign debt crisis.
Very early on.
Yeah, it was October of 22, I
Right
think.
around. Yeah.
Something like that. So what's happened in Japan is the government took on insane levels of debt, something like, 260% of gross domestic product. And that's fine when you have interest rates of 0, or in the case of Japan, for a while, they actually had negative interest rates, right? So if by taking on debt, somebody were to give you the money that you were borrowing and then also give you interest on it, so you were making profits on that, we'd all do that as well, right? And so, because of that, Japan could afford to run up massive amounts of debt. They spend, like the US Congress does. And so what happened was we started to have inflation all over the world, and central banks all over the world, the Federal Reserve, the Bank of England, the European Central Bank, all started raising rates. And the Japanese, the Bank of Japan, which is basically the Japanese government bank, they kept the rates on their 10-year, they've kept rates below 1%, but for much of that time, Rob, rates were something like 25 basis points or 50 basis points, like really, really cheap. Whereas, in the US, we were looking at numbers that were in the 4 or 5% range. And so what happened was people sold yen at, almost 0% rates, and they bought dollars, and it's called the carry trade. And they were booking what were, close to risk-free profits, as long as you could hold on to the currency differences and didn't lose money on that. So all of that buying pressure of the dollar and selling pressure on the yen pushed the yen out past 150 yen to the dollar. Now, is that a big deal? Yeah, it is if you're Japanese, because Japan is a small island nation. They have to import a lot of their goods, and they have to import their energy, and most energy is priced in US dollars. So a couple of years ago, the yen was trading at 115 yen to the dollar. That slid about 30% to 35% to more than 150 to the dollar. And so, for all the people listening to this who, have felt frustration over the last couple of years when you go fill your car up with gas or heat your home, because energy has gotten more expensive. Imagine being Japanese and doing that and having to pay another 30, 35% because your currency has depreciated against the dollar. Now, to make things even worse, Japan has had negative GDP growth for the past 2 quarters. They entered recession in the middle of last year. There's no guarantee it'll be positive this year. And they have now slipped, despite Germany's problems, from the 3rd largest economy in the world to the 4th largest, having decreasing GDP, massive government spending, a declining yen, and an enormous problem with your interest rates, right? Where you can neither raise rates because your government can't afford to pay the interest on all of that debt, or lower rates because then you'll crash your currency and create an inflation problem for your people. They are incredibly stuck, right? They're in a position now where no matter what they do, it's going to end badly. And I would just point out that this is a warning to overspending, over leveraged economies like Western Europe, the European Union, to Great Britain, and here in the United States. And that's kind of the order where we're going to see these problems. But what we've been saying for more than a year is you're going to see a huge problem in Japan, then Europe, then England or the UK, and then here in the United States. I don't think we're necessarily in good shape here. We're just a few years behind Japan's disaster.
Very interesting. Thanks for breaking that down, Gary, and very interesting to see how that all plays out. Point number 7 in our bonus round of this week's 5 things. We're talking with Tracy Schuchart. I think you did a Twitter Spaces, X, YouTube, all over the place. She goes by @ShyGirl on X, CHIGRL. She gave you her oil predictions for the year. Talk a little bit about that conversation you had with her.
Yeah, so she's a terrific energy expert. She was kind enough to have me on her Mic Drop Markets, her Twitter Space show a couple of weeks ago, and she had me on with Jack Farley, who's somebody I respect. Jack started, as a journalist, became a podcaster, but I will tell you, Rob, when you talk to Jack about things, he's basically like a professional investor at this point. I don't know anybody on his end of the microphone who knows finance or companies as well as he does. So, you really have to be on your toes when you're talking with Jack. But Tracy was kind enough to have me on. And then I had the great opportunity to turn the tables and bring her on. And we do have that video uploaded here on YouTube. And so, Tracy was talking about her predictions for oil for the rest of this year. She thinks we remain range bound with a wide range. Let's clarify that. So, a wide range means there's going to be a lot of wiggle room in the price of oil. It'll be up and down a lot, but she thinks it'll stay within a range for the year. And there's some good reasons for that. So the reason we typically are not going to be seeing oil prices, again, in normal times, below $60, $65 is because that's the price that U.S. shale becomes economic. And at that point, the United States is really the swing producer. So if oil prices get down, really below the mid 60s, we're going to see U.S. shale producers increasing production, more oil production. It changes your supply and demand curve, and will sorry, I said that wrong. Below 60, 65, you see that production come off. Sorry. U.S. producers start producing less, and that reduction in supply will send prices up. On the high end, if oil prices start to approach $100, that's kind of a disaster for everyone. The Saudis really don't want to see the world go into some sort of extended worldwide recession. The reason is, in recession, people consume less energy. That reduces demand for oil. So when oil starts to approach the $100 mark, the Saudis tend to increase production or release reserves. And so I think long term, we're going to be looking at higher oil prices. But for this year, Tracy's right. We should be looking at, something range bound. She's thinking mid 60s to mid 90s. That is a pretty wide range, but I happen to think she's right on this. And then in the next few years, we'll be looking for higher prices for oil.
Thanks so much, Gary. That's a wrap on this week's 5 things, or maybe the 7 things for this week and future weeks, as the craziness of the financial markets pick up pace and we roll into 2024. Thanks again, everyone, for watching, regardless of what channel you may be on. Be sure to subscribe on YouTube. Would love a follow on X or Twitter or anywhere else that you may be listening. And be sure to subscribe for a free subscription. Get added to our mailing list, newsletter list, where we deliver content and information on a regular basis, as well as some insights into premium content and reports as well. Gary, any closing thoughts to kind of close up the opposite issue?
Yeah, just, hat tip to George Costanza there. We had an opposite week of news. We'll see what comes up next week. Rob, thanks so much for getting up early on a Sunday to do this with me. I appreciate it. And for everyone watching this, thanks for your time. We know it's valuable.
Thanks so much.